Gift and estate tax planning is often of primary importance to our high net worth clients. Current law allows each person to transfer up to $11,400,000 to their children or grandchildren without paying any gift or estate tax. But that exemption amount is scheduled to drop in half automatically on January 1st of 2026. Depending on the outcome of political elections, the exemption amount could drop further and quicker than that. With a current flat tax rate of 40% applied to all assets in excess of the exemption amount, gift and estate tax planning is important not just to clients who currently exceed the exemption amount, but also to clients who are likely to exceed the future exemption amount based on the growth of their assets and potential reduction of the exemption. For clients who are interested in maximizing the amount of wealth that can be transferred to the next generation, life insurance is often a perfect asset to use because the leverage that you get from making a gift of the premiums, but having your heirs receive the much larger death benefit amount. In addition, life insurance death benefits are generally income tax free, allowing that much larger death benefit to be received without being reduced by income taxes. However, in order to avoid having the death benefit itself subjected to estate tax, the insured cannot be the owner of the policy. Most often, we use an irrevocable life insurance trust as the owner to hold and manage the policy during the insured's lifetime and also manage and distribute the proceeds following the insured's death. On the topic of minimizing gift taxes, a properly drafted ILIT will minimize the use of estate and gift tax exemption by allowing some or all of the contributions to the trust to qualify for the gift tax annual exclusion, under which each person can give up to $15,000 per year to as many people as they'd like before having to use gift and estate tax exemption for anything in excess of that amount. One tricky thing about making gifts in trust rather than gifts directly to the beneficiaries of that trust and still qualify for the annual exclusion is that the annual exclusion is only available for gifts of a present interest, where the beneficiary or recipient of that gift can benefit immediately rather than at some point in the future. In order to convert what is ordinarily a future interest into a present interest, the beneficiaries of the trust need to be given a limited withdrawal right, typically a 30-day window, within which they can withdraw whatever property was contributed to the trust, and only if they fail to exercise that withdrawal right does the property remain in the trust and get administered under the terms of the trust agreement. These limited withdrawal rights are typically referred to as crummy withdrawal powers, so named because crummy was the somewhat unfortunate last name of the first person to utilize this method of obtaining the annual exclusion for gifts made in trust. But how irrevocable is an irrevocable trust? A lot of clients want to know. When we say that a trust is irrevocable, what we mean is that the terms of the trust agreement itself generally cannot be changed by the creator of the trust, the grantor. What a lot of people don't recognize, though, is that a great deal of flexibility can be built into the terms of the trust agreement itself so that the trust can properly respond to changes in circumstance in the future. The trustee can be given broad discretion over when to distribute assets to the beneficiaries, or even how to allocate the assets among multiple beneficiaries. The grantor's spouse can be included as a discretionary beneficiary of the trust so that if the spouse needs the assets, those assets can be available to be distributed, but if the spouse doesn't need the assets, they can be protected from estate tax. The grantor can be given the ability to remove and replace the trustee at some point in the future if the trustee is not operating the trust in the manner that was intended. The takeaway from all of this is that high net worth clients should consider using life insurance to leverage their gift tax exemptions into the much higher death benefits that can be received from a life insurance policy, and should also consider using an irrevocable life insurance trust to own that policy in order to keep the death benefit outside of their taxable estate.